Hey everybody, Marty Mazur, good morning. It's the 17th of December 2018. Just a quick commentary for you today on the video. In front of you is our live S&P 500 chart, which I'll get to in a second. But first I wanted to just talk about a little bit of what you've been reading on the blog and reiterate a few points. What I have been showing lately to you is some technical indicators that are lining up the way they tend to line up when corrections and bear markets are bottoming. This morning, the Dow is down 280 points as I speak, and the S&P is down 30, so it sure doesn't feel like anything's bottoming at the moment. In addition to the indicators I've been showing you this weekend, I added bearish sentiment among the American Association of Individual Investors survey, which hasn't been this high since the bottom of the 2016 big correction, which, by the way, happened to be the worst start to a year in history. So over the weekend and this morning, just looking across all the global financial headlines, it's tough to find optimism except among some of the bigger players who have been around a long time. We're seeing money supply, cash on the sidelines has been growing notably of late. And again, sentiment is absolutely in the gutter. Believe it or not, those are two other characteristics that tend to be consistent with market bottoms. Think of it this way. Right now, the world is suffering from an intense fear of losing. And again, a lot of cash on the sidelines. When the world goes from the fear of losing to the fear of losing out, and of course I do mean when, it's not an if. The question is when and at what level will that occur? But when you get there, the rebounds tend to come very, very swiftly and very, very violently to the upside. Imagine everyone going from the fear of losing to the fear of losing out with all that cash on the sidelines. Of course, you know what happens. People who own stocks will not sell them. Therefore, those who want to buy them push the prices way up in the process. Now, if we were dealing with overall fundamental bear market conditions, I would tell you, look for a rally, but do not get excited about it at all, because in bear market conditions, it would be unsustainable. But we still are not in bear market conditions. When you look at the weight of the evidence, we are still in an economic expansion and still in a long-term bull market in stocks. What we are still dealing with today is a correction within the context of an ongoing bull market. How deep that correction goes and whether or not it morphs into a bear market and conditions roll over, of course, remains to be seen. You clients out there, as I've reiterated over and over and over again, this price action does not dictate our long-term allocation. Volatility never does. What does is overall general conditions. We could get more defensive at lower levels. That tends not to happen. What tends to happen is you get bounces out of periods like this before things roll over. But in the realm of possibilities, certainly things can continue to get worse, and we could roll over into what inspires us to adopt a defensive posture, which is fine. What's not fine is if we adopt that posture before it's time to do that. That's where big mistakes are made. So now, looking at just the immediate snapshot, right now this morning, the market is trading below the closing low when the first correction this year actually officially bottomed on closing basis was right at 2580 on the S&P. And as you can see right now, we're coming below that. Will we get a big intraday move? You can see the next day at particular close, the market sold off in huge fashion. And you can see that's when huge money came in and pushed it all the way back up. And then we had a big, substantial rally in the market to come down, test that level again before we moved into where we are now, testing that level once again right now. If this level doesn't hold over the next few days, then we're looking at lower lows, all things being equal, still within the context of an ongoing bull market. So I think it's safe to say that a catalyst would be needed at this point. Why would everybody come rushing in if things stay the same, if we don't get any good news? That's a legitimate question. If it needs a catalyst, where would that catalyst come from? This week, the potential is there in the Fed meeting tomorrow and Wednesday. Wednesday would be when they tell us what they're going to do with interest rates. Fed funds futures give about a 70% chance that they're going to raise interest rates a quarter of a point this week. That's what I would expect. That's what I think they should do. The economic data certainly supports that move. I also think that they will be dovish in their commentary. And now, contrary to what I felt at the beginning of the year, I do think that would be a smart move as well. I think because of what we've seen in terms of slowing growth, not contraction, but a slowing rate of growth in the global economy, and I think we're starting to see that here in the US, that dictates that the Fed should soften its stance and not look at raising interest rates 4 times next year. I think this slowing growth has everything to do with the threat of a global trade war. Ultimately, putting that fear to rest is what I think this market needs to get back above these September highs and keep moving into all-time high territory, which absolutely should be the case given the macro backdrop. But that's not where we are right now. Right now, we're swimming in a sea of fear and, frankly, a growing ocean of cash on the sidelines. Once again, those are characteristics of a bottom. Whether or not that means we're bottoming now or at some point later, these are the characteristics that will be existing when that bottom ultimately comes. Folks, thank you as always for watching and listening. And of course, I'll be back a bunch this week. Take care. Bye-bye.